So Tommy, let's just say we got somebody that's turning 73 and then they got to take an RMD. Walk them through it.
First RMD at 73 is rounded to 3.77%. So on $1 million, that amount is $37,735.85.
In change. Right. In change. Now, if it's $2 million, I mean, you simply just double it. I mean, the math is the same. The percent, right, is what we're looking at. But on a $2 million, you're at $75,000 in change. And then if you're at $500,000, it's $18,000 for the year. So again, I mean, we work with people across the board. And it just depends on the size of those IRAs. Now, here's a question. So let's say you have 3 or 4 different IRAs, Tommy. Do you have to take an RMD from every one of those accounts, or do you pull from one? How do you do it?
Yeah, you want to look at your account types. So IRAs, specifically IRAs, can be grouped together. A lot of times you get into an IRA and a 401k, maybe a 403b. If they are different tax types, then you would want to satisfy them individually.
Okay.
So just sit down, figure out what types of accounts you have. Are they all IRAs? Then it can be taken out of one account. If you have different things in there, you want to satisfy them individually.
Yep, absolutely. I mean, here's the deal though. The whole purpose of what we're, and you all know this. I mean, for those of you that have been watching this for some time, we want to be tax smart, right? One of my big missions is how do I save people money in taxes? That's what we're trying to do here. So how do we become tax smart with minimizing required minimum distributions? So one of the things that we do here with our company, especially with our clients, is we do what we call it a mock tax return, which is where we look into the future, because so many times, right? Well, Tommy, here's another question we didn't talk about. So let's just say that you want to do a Roth conversion. Okay, I mean, what's the timeline in order to do a Roth conversion?
Roth conversion is calendar year. So it happens in the calendar year. You do the Roth conversion January 1st to December 31st.
And so that's where I'm getting at, because when we're planning and you want to do a conversion, it may already be too late because you should have done it before that end of that calendar year. And so taking a look at the RMDs in terms of, okay, do we pre-plan with it? Do we do pre-RMDs? I mean, let's talk about these examples and then we'll dive in a little bit more. So,
I mean, if you're out there looking at your RMDs, we touched on the percentages, but starts a little under 4%. At 80, it's a little over, right around 5%, and then at 90, it's right around 8%. And so, depending what kind of assumptions you're using, how your account may be invested. Are you looking at growing 5, 6, 7% a year? If you have those assumptions in there, then that RMD just continues to get bigger until the percentage you are required to withdraw kind of outgrows or is larger than the amount the account grows. And so this is why we talk about planning. You're never going to get it exactly right, but at least you have an idea of where you're going and can you be tax smart now.
I like the visual aid of things and really showcasing how do we do it here. Take a look at this example. This is big, so make sure you stay with us on this. Okay, so here we got a married couple. We have with $275,000 in combined non-portfolio taxable income. They've got they're taking the standard deduction right now with their taxes. And also they have $2.5 million in combined tax deferred accounts at age 59 and a half. Okay, the annual growth rate 6%. I think that's fair. I think that's conservative enough. I think that's okay. Take a look at this, folks. Okay, so you can see they've crossed over the 10 and 12% tax bracket. They've crossed the 22, they're into 24. But look what happens down the road if they did not do any planning with the required minimum distributions. Tommy, look at this. Boom, the tax bomb just hit, and look what it just did. It popped them not just to the top of the 24, they just crossed 2 more tiers.
It's important when you are tax planning is to look at how the tax brackets are bunched.
Right.
So 10 and 12 are close together. 22 and 24, those are close together. And then 32, 35 and above, those are close together. But between them, you go from 12 to 22, that's 10% difference. You go from 24 to 32, that's an 8% difference. So
right.
That when we talk about planning, it is looking at what marginal rate are we paying right now? Is there an opportunity in the middle to do some of the pre-RMD or the pre-distributions when
Sure.
we're looking at Roth conversions? And then where are we going eventually?
Eventually, that's right, our tax landscape. And so, folks, I want to be clear. I mean, if you have this going on, you got a good problem, okay? I mean, this isn't a bad thing at all.
It is not. It is not a bad thing.
Well, from a tax perspective, it is. But
from a tax perspective, can
Yeah.
you be smarter? But it is not a bad thing to have,
right.
an RMD that you're going to be forced to take.
That's right.
In the future.
Yeah, to be smarter with it. Okay, well, let's talk about that. Okay, so this is for a couple that did no pre-planning. Now let's say that they did. So here, what they're going to do, I mean, this is a very simple concept. In this example, let's go back to where they were with their income. And so you can see that coming in. But then they just did some Roth conversions, for example. And what did they do? They did not cross that tax bracket because, again, I don't want to pay more tax. I don't want to pop into that higher tax bracket and pay unnecessary tax. So they just got to the top of the tier. What are they doing? They're bracket bumping. And look what we did. Then the RMDs kicked in. We kept them in the same bracket throughout those years, up until a certain point, but by that point, they're age 95.